Okay, hi there, it's Geoff here. Now this is a key macro video. We're going to be spending a little bit of time thinking about the nature of demand side shocks in the macro economy. So what's a shock? Well, a shock is a sudden and often significant change in aggregate demand for goods and services. And these shocks can often lead to a disruption of the economic equilibrium, leading to quite sizable changes in real output and jobs and inflation, often all three. And demand-side shocks typically arise from unexpected events, particularly external in the world economy, or unexpected policy changes. So a couple of examples, maybe two or three from the UK. The cost of living crisis, of course, has been with us for the last, 3-4 years. High inflation, peaking at over 11% in 2022 in the UK, driven by soaring energy and food prices, people's real disposable incomes taking a hit, affecting consumer spending, and that has knock-on effects for industries such as retail, hospitality and leisure. The pandemic, of course, brought about a demand-side shock in 2020. From the spring of 2020 onwards, the lockdowns caused a significant fall in demand. Hospitality, travel and retail all affected, and other sectors. Post-pandemic, there was a rebound in demand, an increase in spending, and that actually led to supply chain bottlenecks and again a rise in inflation. And there's also been a degree of Brexit-related uncertainty, particularly not after the referendum in 2016, but after the trade deal in 2020. So following the UK's departure from the single market, there have been growing concerns about trade disruptions, the impact of non-tariff barriers, higher costs of doing trade, impacting business investment and consumer confidence. That's a kind of ongoing shock with ripple effects as we speak. There are some big effects, obviously big shocks affecting the world economy. The biggest would be the global financial crisis. And we'll spend a few minutes on that in a second. But the Russia-Ukraine war from 2022 onwards has caused a steep spike in the price of oil and gas. It's disrupted global supply chains and clearly impacted on people's real incomes and demand and output in several countries. Some nations more exposed to that than others. Yeah, let's just spend a little bit of time thinking about the global financial crisis as a demand-side shock. This chart shows the growth of world GDP in 5 years. Now, normally the world economy grows by about 3% a year. And you can see it was booming in 2007 as the global financial crisis was about to unleash itself. Output was still rising in 2008, but less than the average. And of course, there was a fall, an actual recession in the world economy. Very unusual. GDP fell by 1.33% in 2009, before picking up in 2010, but then slowing down back towards its average. So this was clearly a major shock for the world economy. It caused a sudden fall in demand across multiple industries and regions. The crisis, as many of you will know if you've studied this, and you need to as part of your course, began with the collapse of the US subprime housing market and the subsequent failure of many financial institutions, including Lehman Brothers, leading to a widespread credit crunch and fall in the supply of credit. And millions of businesses and consumers faced with fall in the price of assets, tightened access to credit, and a drop in confidence cut their spending and business investment. Financial contagion spread quickly through the world economy. We live in an interconnected economic and financial system and trade system. Unemployment rose, household incomes shrank. So the contagion effects created a wider financial multiplier and an economic multiplier effect. Businesses were cutting back on production, they were hiring fewer people, and of course this led to a cycle of reduced spending, deepening the recession. We've already seen that output fell. Look at the value of trade. So the value of exports of merchandise products, again, fell very, very sharply in 2009 as the world economy fell into recession. So a significant contraction in the value of world trade. And one of the ideas, if you have a demand-side shock, one of the ideas you can bring into any analysis is the idea of a negative multiplier effect. And if you've studied this, I'm sure you have as part of your revision, this happens when an initial decrease in spending leads to a final, much bigger fall in output, in jobs and incomes, because one person's spending is somebody else's income. So a cut in spending in one area of the economy ripples throughout the system, causing a cumulative contraction in aggregate demand and GDP. If we think about the cost of living crisis, the spike in the price of energy, the bills going through the roof, dual fuels for electricity and gas, caused a big rise in the price of energy. Food prices also going up, housing costs going up. So your real income, your real purchasing power was hit. And then businesses were then hit in businesses and sectors reliant on discretionary spending. So people have a choice over what to spend, but of course if energy bills were going up, they had less to spend on other things such as hospitality and leisure. So other industries were then affected by that. Firms were contracting production, laying off workers to cut costs, and then that has the ripple effect on employment, on jobs and incomes. So layoffs, fewer hours, less overtime means workers have less to spend, again further decreasing demand. So you kind of get a perpetuation of the cycle. So the key point to take away from this is that when you have a demand side shock, there's always the risk of a negative multiplier effect. And we can model this using ADS analysis. So here's the initial fall in demand, causing a contraction in real output from Y1 to Y2. If you get a question on demand side shocks, that's fine, creating a negative output gap. But the best students then take it one stage further, say, well, there could be an even bigger fall in demand with a negative multiplier effect. Now that's a good diagram to draw because it suggests that the initial demand side shock could have deeper consequences. So please do use that diagram in the exam. How can you adjust, absorb, how can you mitigate demand side shock? Well, you essentially have two main policies in the short term at least. So fiscal policy and monetary policy. On the fiscal side, governments can inject extra spending into the economy on infrastructure projects, on healthcare, increased funding for education and local services. So in theory, an increase in government spending can inject money into the economy, create new jobs and extra demand for materials. Governments can offer targeted financial support, and that's certainly the case in the cost of living crisis. So direct income payments or cash transfers to help cope with energy bills, at least supporting consumption. You can cut taxes. Now, whether or not you should cut taxes in a situation here, of course, depends on people's propensity to consume. Do you cut income tax? Do you have a temporary reduction in VAT to stimulate spending, or do you try and cut business taxes? Either way, the aim, of course, is to leave more money in the hands of households and firms, encouraging more investment. And you can also impact on the labour market. So maybe cutting employment taxes or subsidising wages. Of course, the UK government brought in a £75 billion plus furlough scheme during the pandemic, and it did provide significant support during that lockdown and that prevented a much deeper recession than we actually saw. Monetary policy can work as well. So as we saw in the aftermath of the financial crisis, central banks around the world were cutting interest rates. The Bank of England cut interest rates from 5.5% to less than 1%, trying to generate more demand in the economy, trying to bring down the cost of people's mortgages. They also introduced quantitative easing, where the central bank goes into the financial markets and buys existing government bonds of pension funds and banks to increase liquidity in the financial system. And you could also maybe relax the regulations on the supply of credit, incentivising banks to hopefully lend out to businesses and households who need to borrow. So it can also intervene in the currency market. So there we go. So sometimes a fourth option, if you have a managed floating currency system, is to sell your currency and buy overseas currencies designed to bring about a currency depreciation, which then in theory stimulates the export side of your economy. So there's a variety of ways, fiscal and monetary, that you can use to absorb a shock. And the key thing is what works, what works initially in the short term. Keynesians tend to prefer fiscal policy, whereas monetarists believe that monetary policy is a more effective instrument. And of course, there are downside risks with using both. But there we go, a quick look at the cause of demand-side shocks, the ADS analysis that goes with it, and some thoughts on policies to absorb the shocks. Thanks for joining in. Take care. See you soon.